Hello, welcome back. In this video we are taking a look at MillerKnoll. It is a company that was suggested by one of our viewers, and it is a very interesting case actually. Now, even if you are not interested in this company, I would really urge you to watch this video because it can really help you with understanding how to analyze all sorts of different companies. And this one has numbers that are a little bit all over the place, is what our viewer has told me. And boy, was he right. But we will actually try to examine why this is happening and get down to the finer details. Again, I think this is a fantastic case study, and so bear with me and take a look at how we're going to analyze. I'm going to be doing it live, although I have obviously done the homework before actually recording the video. But I will show you how I go about it. Okay, so we're looking at MillerKnoll here, which is currently sitting at $21, and it's down almost 50% from its one-year high. Now, if you take an initial look here at our tool, you can see the ratios of the company, like for instance a 20 in its P/E ratio and a minus 15 though in its free cash flow. This is actually going down, it's becoming worse. Now, what is going on here? Like, why is the P/E ratio positive and rather low, or I guess okay, and the price to free cash flow negative? Of course, we're going to examine that using the financial statements. Now, what about the revenue growth? You will see that there is an insane spike here. So why? Why did that happen? That's another very interesting thing, because you will notice that in the previous years, this was almost dead here. This was almost like linear completely, or just going a little bit up, a little bit down. So what happened here? This is the odd one out, and we need to know what happened. Now, before we actually examine what happened, I wanted to take a little bit of a look here. And obviously, I know that this company has to do with furniture. You will see here in the company profile that they are an industry, that they are furnishings, fixtures and appliances industry. And they research, design, manufacture and distribute interior furnishings worldwide. And as you'll see, it's a company that is very old, an old IPO. It's a company that has been operating for many years. Now, if we go back to our metrics page, you will see that this company is about $1.6 billion in market cap, so it's not a big company really. Yet it's not too small either. And it's a consumer cyclical company. The reason for this is that they are selling furniture, and so furniture tends to be cyclical. There are, cycles within the economy where furnishings are actually doing well, and sometimes they are doing badly. It really depends on the current economic climate. And you can kind of see here, I took a little bit of a look at what is going on with the market, the furniture market in the United States, for instance. And you will see here on Statista that the market is expected to grow annually by about 4%. That's the CAGR, CAGR, the cumulative pretty much growth. And as you'll see here, in global comparison, most revenue generated in the United States, that is 2.5.9 billion, 2.252.9. And also, you will see here that the global furniture market, that is, was valued at about 648 billion in 2021 and is expected to expand at a compound annual growth rate of about 5.7%. Just to get a sense of what the market is doing is the thing. Now, of course, as you can understand, this has a lot to do with housing and has a lot to do with credit as well. So if interest rates keep rising and if the real estate market goes wrong, then this will go wrong as well. So this will definitely follow what the market is going to be doing there. But okay, we kind of know all this. What is up with the company? What about its financials? Let's take a little bit of a closer look now. Okay, the thing that we see here is that the company is actually issuing shares, and again, it looks like there is a spike here, which we will examine why it happened as well. Now, the net income growth of the company has been going down, and you normally obviously like to see companies making more net income rather than going down. This is sort of like a roller coaster going up and down. It's something that I don't like to see. And the free cash flow is also going down, another bad sign over here for the company. Now, you will see that the margins of the company are pretty low as well, which you would kind of expect from this kind of company having relatively low margins. And also they have quite a significant amount of debt here. 1.2 is what we're seeing here, 1.25, which is about 125% of their equity in debt. That's quite significant, especially since the company is paying 3.5% in a dividend, which is negative in terms of its free cash flow, so they don't even have enough to fulfill that right now, based on the last year's free cash flow. And the payout ratio is very high. That's based on the net income, which has been increased, as we saw earlier. Now, why has it been increased? Again, we are going to examine that. But if we take a look at the financial statements, which should tell us why, the revenue is, what happens with the revenue, basically, you will see here that they started from 2.3 billion, 2.5, 2.4, 2.4, and then all of a sudden they shoot up to 4. So what happened over here? This is basically net sales. This is actually happening from sales, but how could they jump 60%? That doesn't make a lot of sense. So this is where we're using our tool here. And we take a look at our company analysis page, and you will see that we have the SEC filings. Now remember, you can gain access to this tool by becoming a patron. All the links are in the description box below. You can do this kind of analysis that I'm doing here on your own using the tool, and for any company, frankly. And I'm taking a look at the 10K. So I have already done that, but if you click it, it will open up for you. And this is what you'll see. If you search for net sales of the company, this is exactly what I searched for. It's basically Control F, what I did pretty much, or Command F on a Mac. You'll see that net sales were about 3.946 is what we saw here in our tool. 3.946. Again, let me take it back so that you see exactly what I'm reading here. 3.946 is what we're seeing on the statement. Representing an increase of 60% when compared to the prior year. The increase in net sales was driven primarily by the consolidation of MillerKnoll results from the date of acquisition of July 19, 2021, as well from some growth that they had too. And so, once I read that, I'm like, okay, what kind of acquisition? And I took a look at this one, Herman Miller and Knoll, complete merger become MillerKnoll, and this is why you're getting this kind of increase here. A few months after Herman Miller announced the 1.8 billion merger with Knoll, the two Heritage office furniture brands complete the deal and reveal a new name, MillerKnoll. So this is what is happening over here. And this is why you're seeing this insane increase over here in terms of revenue. But again, this is not representative of the historical revenue. And this is what we need to keep in mind. If you take a look at analysts, they are projecting about a 3, 4%, 2% in terms of revenue growth for the upcoming years, is what I'm seeing. Okay, now of course we'll see whether that will happen, but what I'm saying here is that you shouldn't really be expecting this kind of growth here. This happened because of the consolidation. Okay, so what about the balance sheet here? Now you will see that in the balance sheet again, we will see that the company has a total equity of about 1.5 billion, which was pushed because of the consolidation again, because previously it was about 900 million over here. And in terms of the cash flow, the cash flow statement over here, as you'll see, we're getting into negative territory. The free cash flow is getting into negative territory. And the net income of the company is actually getting in negative territory as well. Again, even after the consolidation. This is not looking great here for a potential investor. And the thing is, if we take a look at our tools here, our evaluators, we can actually use both. Because if you take a look at the metrics page, you will see that the actual amount of the payout ratio that the company is paying in terms of their net income is actually quite high. Now, this may have to do with the fact that they are not making that much in terms of net income, at least at the moment, or their free cash flow is even negative. But I am willing to bet that their payout ratio will remain high for the upcoming years. And this means when we're having a company that pretty much doesn't really grow a lot, and this is typical for a company of this sort, like a furniture company, then we can definitely use a tool like this, the dividend discount model. That's the Gordon growth pretty much tool. That's the second tool that we can use for evaluating a company and how much it's worth to be buying it for. And that's based on annual dividends. Now, as you'll see here, this gives you a very, very handy little table that tells you how the dividend has been growing over the years, and also gives you the payment frequency, the dividend per share, and everything of this sort. You can kind of use our page over here, this other one, the dividends tab, in which you can see that the company has actually lowered their dividends lately, even though it used to be higher in the previous years. You can kind of get a sense of what they are paying overall. Now, if we go back to our stock evaluation tool, the dividend discount model, what can we do here? So the annual dividend yield is about 3.5%, and the average dividend growth rate has been about 1.2%. You can kind of see it exactly how it happened over here. It has been going down in the past couple of years. But we should expect something like maybe 1% a year. I think that is fairly normal. So I'm going to go 0.5 for the first case. That's the low case. 0.8 over here. Let's go 1.1 for our high dividend growth case scenario. And again, this has to do with what I'm seeing here in the growth rate, and also the dividend growth rate pretty much broken down in this little table. And the annual return that I'm going to ask for is not going to be what I typically ask for my discounted cash flow model, because the company doesn't really pay all its earnings back to shareholders. So we are seeing something like maybe 70% here. Again, this may be less, this may be more. For a company that doesn't really make that much money, this can be, a picture that is a little bit out of the ordinary and could change in the upcoming years. But I'm willing to go for something like, let's just say 6% here. So let's just say that I'm looking to get a 6% annual return for my dividends, here, and also accounting for the fact that the company will be growing as well in terms of its stock price. Organically growing in terms of its stock price, potentially. Now, again, this is not really a company that grows much in terms of its stock price. It shouldn't, all things considered. But again, I'm gonna consider in this scenario that that I'm going to ask for a 6% return. Of course, when you get access to the tool, you can do all sorts of scenarios and see what you're getting for your cases. And so in this case, for a 6% annual return, it would make sense to be buying this company at $13, $14 or $15 over here, again with these kinds of values here. For 1.1%, 6% annual return, $15 would make sense. Currently we're sitting at 21. Now if we go a little bit lower, maybe we ask for like 4%, this means that we're going to be getting significantly better values, and all of these are becoming green over here. So if we're looking for just a little bit of a dividend yield, dividend return, I should say, annual return, this is probably fine, although 4% is not really great, especially judging from the fact, again, that the company is not really making tons of money, is another big problem here. Now I'm going to turn to our stock evaluator, which is the typical method of evaluating what the company is going to be doing in terms of its free cash flow and in terms of how much money they are making. The numbers are all over the place, especially this last year, because again, we saw what happened is pretty much the merger. And the revenue growth, because of this reason, the averages are again all over the place. But again, as I told you, we're expecting something like, let's say, 2, 3, and 4%. Now, the net income margins of the company are low and sitting again all over the place, sometimes negative, sometimes positive. I'm going to go with something like 3, 4, and 5. These companies can be really, really hurt from a recession. So if that happens, they can go much, much lower. So I would edge for some caution here. In terms of the free cash flow margins, I'm going to go with something that is rather typical, because likewise the company is all over the place with that. I don't like these kinds of companies. They don't have solid numbers that I can actually predict. That's a big problem. And the annual return that I'm going to go for, the typical one, 13%. Again, you can kind of combine that a little bit with dividends if you want and bring it down a little bit over here. Just ask for less potentially. Again, all these scenarios, you can play it out by having access to the tool, of course. In this video, I cannot try 50 different scenarios for each company, but you get the idea. And so, what are we seeing here? So in this case, we are looking at an 18 for our low, a 28 for our medium, and a 41 for our high here, with the current price sitting at 21. But remember, we had some assumptions here, like the free cash flow margin is rather high compared to what the company has been doing, at least because of the fact that some years are positive, some years are negative. They are all over the place, so you cannot reliably use this one. You could even try to go lower and see what happens. And also the revenue growth could even be lower. So judging what I've seen, this is a company that is not expensive. It doesn't look like it is super expensive. However, it doesn't look like it's a great deal as well. So if you take a look at the 3-year chart, you will see that it has been going down. It has had this kind of downwards momentum as well over here, then it went up and then down again. That's probably when the stimulus happened, I suppose. But it is a kind of company that could go up and down a lot. It's a big bet. It's probably a bet that I wouldn't be willing to take. But I hope you did enjoy this kind of content. It kind of helped you analyze these companies a little bit deeper. Hope you enjoyed. I hope you liked this video. Please leave a like and subscribe if you did. And I'll see you in the next one, guys. Thanks for watching. Bye-bye.